Right now is one of the best times to start an emergency fund. Interest rates have been going up, and many online banks like SoFi have raised their interest rate. In this video, I'll go over what an emergency fund is, why you should have one, how much to save, and I'll also give you reasons why you shouldn't make one. An emergency fund is money we set aside for emergencies. Money that we set aside for unexpected expenses. Because emergencies can happen at any time. Throughout our lives, there will be unexpected emergencies. Unexpected expenses that come out of nowhere. There will likely be times in which these emergencies happen back to back. Having an emergency fund allows us to pay these expenses. The emergency fund allows us to pay for these expenses without going into high-interest credit card debt or taking out a loan to pay for it. An emergency fund is also useful for protecting your investments. It would suck if you had to sell stocks at the bottom of the market because you decided to not have an emergency fund because it doesn't return as much as stocks do. Or because you're afraid of losing money to inflation. An emergency fund isn't there to make you money. It's there to cover you in an emergency. An emergency fund is kind of like insurance. This insurance can protect you if you end up losing your job or you decide to switch careers. It gives you time to search for another job. It protects you from having to sell your stocks, assets, whatever it may be to pay for an unexpected expense. It allows you to pay for an unexpected vet bill and also an unexpected vehicle repair bill. Because after you pay hundreds of dollars to get blood work done on your dog, your vehicle ends up breaking down a couple hours later. An emergency fund is a safety net. It's also one of the first steps people can make when it comes to getting your financial life together. For the most part, it's just insurance. You're not supposed to make money off of it. But since interest rates keep going up, if you join an online-only bank, you can actually get a pretty solid return. Since online banks have less overhead than traditional brick-and-mortar banks, they can actually pay you more interest for money in your savings account. Right now, SoFi is paying 4% interest on money in your savings account when you set up direct deposit, which is actually a solid return for money setting in an FDIC-insured bank account that you can withdraw from at any moment. And if you sign up to SoFi using someone else's link, you can get $25 as a welcome bonus when you deposit at least $10. And you can get even more if you set up direct deposit. My link will be at the top of my link tree. Feel free to use my link or someone else's link in order to get that welcome bonus. It's generally recommended to save 3 to 6 months of necessary expenses to fund your emergency fund. If that's too much for you, a good starting point is to just simply save up $1,000. How much you should save depends on your personal circumstances. If you're living at home for your parents, then $420, $500, or $1,000 might be more than enough. 3 months is generally recommended if you're single, and 6 months is generally recommended if you have dependents. What I mean by necessary things is stuff like rent, mortgage, food, utility bills, transportation. And of course, if you wanted to, you could save up more than 3 to 6 months of expenses. Still, it's usually recommended to put that money into a retirement account like a 401k or an IRA. A Roth IRA can also be a backup emergency fund in a way. 5 years after you open up a Roth IRA, you can withdraw what you contributed, penalty-free and tax-free. Still, it's preferable to not take money out of these retirement accounts at all. I do view a Roth IRA as additional peace of mind though. There are some people who are against emergency funds. The reasons are usually that inflation will eat away at the value of your emergency fund, which is one of the reasons why I recommend getting an online bank that pays high interest. A traditional brick-and-mortar bank's going to hardly pay you any interest at all for money in your savings account. Otherwise, these people do recommend investing in instead so that you can grow the wealth more. And that if an emergency happens, you could just simply sell your assets to pay for it. Because investing into index funds, for example, is going to generally give you a higher return than what you're going to get with money just setting in a savings account. Since it went up in value more, you'd end up having more money. Which, in my opinion, these people just don't understand the importance of having an emergency fund. These are also usually the same people who try to time the market when it comes to investing, and more than likely will fail to outperform the market in the long term, which is of course something that they would never admit to. They also generally think that the market always goes up, which historically it does, but there are recessions and crashes in between. There's a good chance that you may actually need some of that money during one of these crashes. One thing's for sure, you definitely don't want to be selling your stocks after it's dropped 30 to 50% in order to pay for some unexpected expense, because you're worried about inflation eating away at money in an emergency fund. I also look at it like this: the average American doesn't have enough money in their savings account to cover an unexpected $500 bill. Also note that America has the highest GDP in the world. America has the biggest economy in the world despite making up 5% of the population, give or take. Yet so many Americans don't have enough money to cover an unexpected $500 bill. This is sad, and don't fall into that statistic. Most people suck with money and they will continue to suck with money their entire life. I do also have to note that an emergency fund might not matter to someone who lives way below their means and they make a lot of money. Then again, if you're in that position, it shouldn't be too big of a deal to save up 3 months of expenses anyway. I could also see some younger people benefiting from investing into stocks instead of building up an emergency fund or starting off with a smaller emergency fund like $500 or $1,000 and not worrying about the 3 to 6 months. One of the main reasons being because they're probably working at a low-paying job and they might not be willing to save up that much money. And investing and living life and seeing the market drop a couple times will probably end up helping change their mind when it comes to an emergency fund. And if an emergency does happen, they do have some of that money in the stock market that they could potentially sell off. In conclusion, there are many people in America who cannot afford an unexpected $500 bill. Throughout our lives, there will be times when we will get hit with unexpected bills and expenses. These can come one after another. Having an emergency fund can save you a lot of pain in situations like this. And it's easy to think that this stuff will never happen to you, but it's pretty much inevitable that this stuff is going to happen to you at some point in your life, if not several times during your lifetime. An emergency fund is kind of like having insurance. I would highly consider keeping my emergency fund in an online bank like SoFi because you get paid much higher interest than what you get at a traditional brick and mortar bank. Another option for an online bank that has a high paying savings account is Ally Bank. They pay slightly less interest than SoFi at the moment, paying 3.75%, but you don't have to have direct deposit set up with Ally in order to get that high interest rate. Also note that interest rates do change. At the moment and in the near term, they will likely stay up, making right now one of the most profitable times to have an emergency fund. Some people are against having emergency funds, but in my opinion, the pros far outweigh the cons. Don't be someone who can't pay for an unexpected expense because you can't set aside a little bit of money in an emergency fund. If saving 3 to 6 months in necessary expenses is too big of a pill for you to swallow, consider just saving up $1,000 instead, or $420.